if we do have a situation where the Federal Reserve does take it above 6% because inflation is just refusing to fall, it's a very tricky position for the central bank as well as for the markets. I think as we're seeing right now, there's a lot of wobbliness in the equity markets. If we do see the interest rate hikes go beyond what the market expects in reality, not just in expectations. And we do see a correction in the equity markets. Investors are going to start bailing out of U.S. assets. But at the same time, the rest of the world, I mean, this is the conundrum, right? The rest of the world, if the U.S. does experience, a deep recession, is going to feel that pain as well. And that those central banks are going to halt their tightening cycles sooner rather than later. So, whenever we're in that position, we typically see the dollar strengthen at the onset because of rate hike expectations. Then we see it weaken over the course of a series of softer economic data. But then it catches a safe haven bid. So, it's a multi-step move for the greenback. But I think, at this stage, what we're really questioning is whether or not we get that deep recession and whether or not inflation it remains and prices remain too high for the Federal Reserve that they have no choice to push rates higher. And it's a very tricky position because I can tell you, the housing market in the U.S. is just beginning to revive itself because we're in the spring season. And in the winter, it was a very, lackluster market. There was no real movement because there's not real inventory. Just anecdotally, even though prices have come down, because there's still a lack of inventory, the market's just beginning to heat up. There's still lines out the door for open houses, and prices are not accelerating as quickly as they were before, and America's not as bidding and overbidding. But prices aren't coming down as quickly as you would think at these interest rates either. So I think all of that is going to be something that the Federal Reserve needs to deal with in the coming months.
And it's a similar story for wages as well. Kathy, Governor Kuroda's final Bank of Japan policy meeting this week, expectation is that he won't do anything radical. But if this is a transition moment, then what are the implications for dollar yen?
Well, right now, dollar yen is pulling back a little bit. It's had a very nice, run overall. And that has a large part to do with the rally in the U.S. yields and the expectations that the new BOJ governor, who, typically they don't really express their views so early on, is coming in with the idea that continued monetary easing is going to be needed. So if we do not see a Kuroda surprise this week, and, it's 50-50 at this stage, Sri. But if we do not see a Kuroda surprise, I think what's going to end up happening is that, we could see a deep sell-off or a sell-off in Japanese bonds, which could lead to a little bit of, a rise in yields, because it may mean that the new BOJ governor may be forced into actions, sooner than he'd like. So I think it's a knee-jerk reaction at the end of the day, because I think he's shown his colors. I think he's shown that he's not going to be as aggressive to move on policy. But, we could see a knee-jerk decline in dollar yen if there's no movement, really, as they, worry about what this means for, Japanese policy.